Welcome, market participants, to another Three Things in Credit. I'm Van Hester, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So this was a week driven by, of all things, a post-Greenland rally, a descriptor I never thought I'd ever say. With Davos blessedly in the rearview mirror, we can get back to credit. It's a good thing. January public IG volume has pushed past $200 billion, making it one of the 5 biggest issuance months on record. No rest for the weary. Dealer desks are forecasting $185 to $200 billion for February, according to Bloomberg. This week, our three things are: 1. What we're watching. Here's what we believe will shape credit valuation over the near term. 2. Visa Mastercard spending update. The latest read from the global payments titans. And 3. KBRA DLD default forecasts. Our own Eric Rosenthal weighs in with his outlook for 2026. All right, let's dig a bit deeper. What we're watching. So we've just published our Forward Look, U.S. Credit Insights Q1 2026, our quarterly report taking stock of what's driving valuation in U.S. credit markets. So what are we watching? The first thing is policy uncertainty. When we began writing this, Greenland and the future of NATO were dominating the news flow. We thought, here we go again, the return of uncertainty. Then, of course, we got course correction and a framework for a deal in Greenland, almost as if it never happened. But what did happen is a reminder that policy uncertainty has not gone away. Yes, we now know that markets in particular are working as an effective guardrail, but there are still plenty of political flashpoints, both at home and abroad, that could escalate. It's on our radar. We're also watching the path of inflation. Chair Powell acknowledged this week that inflation, excluding the one-time effects of tariffs, has been improving and is close to target on that adjusted basis. But we see the risks to the upside over the near term. Growth is tracking well above potential, driven by continued tech capex and historic wealth effect from the extraordinary run-up in stocks. Additional fuel for growth is due from another round of infrastructure spend, tax cuts and incentive as part of the One Big Beautiful Bill, 175 basis points of cumulative monetary easing over the past 16 months that is working its way into the economy, and expected affordability initiatives in this year of the midterms. Any reversal in inflation will not be welcomed by risk markets. We're watching out for credit cockroaches, high-profile late-cycle credit accidents that surfaced in 2025's second half that made investors wonder if there are more out there lurking. Bank loan quality results thus far have been excellent, suggesting that those cockroaches we saw last year were largely one-offs. But we're keeping an eye out, especially with non-bank lenders set to report earnings in the upcoming weeks. And we're watching AI. Will the promise of value creation sustain? Will the massive investment continue? Will equity market valuations hold up? So much of economic growth and positive investor sentiment at the moment is tied up in this story. The market's reaction to Microsoft's results was not reassuring. You can find more of these stories and a lot more in our Forward Look research report available on our website, kbra.com. All right, on to our second thing, Visa Mastercard spending update. So Visa and Mastercard really are technology firms developing and promoting payment options for consumers and businesses. Yet few firms have a better look at the consumer than these two financial giants. Both came out with earnings this week, and both remain constructive on the consumer. The Mastercard adjusted earnings of $4.76 a share was up 17% year over year on a currency-neutral basis and was 12% better than the estimate. Net revenue was up 15% on a currency-neutral basis. Gross dollar volume was 7% higher globally and 4% better in the U.S. Management highlighted that the positive trends have continued in the first 3 weeks of January. And while acknowledging that geopolitical and macroeconomic uncertainty persists, management remains optimistic and confident in the company's execution and the fundamentals of its business. Overall, Mastercard continues to see healthy consumer and business spending. Now, there are lots of puts and takes in this story. Regulatory changes are afoot, the K-shaped economy, changing consumer sentiment. But management remains positive about the growth outlook, and its base case for 2026 continues to reflect healthy consumer spending. Over at Visa, adjusted EPS of 317 a share was 14% better than its year-ago quarter on a currency-neutral basis, and a tad better than its estimate of 314. Volume was up 8% globally year-over-year and up 7% in the U.S. Management characterized the spending it saw as resilient on the back of what was a strong, better-than-expected holiday season. Consistent with other card industry players, Visa warned that the proposed CCCA, or Credit Card Competition Act, better known as the legislation that would cap credit card interest rates, well, that would have what management called, quote, far-reaching negative consequences, unquote. Specifically, consumers and small businesses would see reduced access to credit, and rewards would be eliminated entirely. There'd be fewer credit card options, weaker security protections, and less innovation. Now, it's tough to handicap if this proposal, unlike several attempts to achieve this in the past, actually moves forward. The good news for now is that it has been pushed into Congress and off the front burner. All right, on to our third thing, 2026 default forecasts. Joining me today is Eric Rosenthal from KBRA Analytics, who tracks defaults across broadly syndicated loans, high-yield bonds, and direct lending. Eric generates our default forecast as part of his work with KBRA DLD, our direct lending news and analytical platform. Today, we'll highlight Eric's 2026 default forecast across those three markets. Eric, welcome back to the podcast.
Thanks, Van. Always great to be on the podcast.
So before turning to your 2026 forecast, let's review 2025 liquid credit results. Anything in there surprise you?
Sure. So liquid market default rates, they came in largely as expected, with results closely tracking forecasts. For broadly syndicated loans, the default rate finished at 4.1%, impacting $64 billion of volume. Our forecast called for a 3.75% default rate involving $58 billion of volume, so close to the final results. Now, on account basis, we projected 63 defaults. There ended up being 65, which resulted in a 5.2% issuer rate. For high yield, the default rate finished at 1.7%. Our initial forecast called for a 2.25% rate, but we noted in March that a second consecutive sub 2% year was likely. Now, from account perspective, we projected 27 defaults. There ended up being 28, resulting in a 3.3% issuer rate.
All right, well, it sounds like you deserve a good pat on the back. Remarkably accurate given how volatile the year was and the news flow was. Now let's turn towards 2026. Will high yield finish below a 2% default rate for a third straight year?
Yeah, we are calling for a 1.75% default rate in 2026. This equates to roughly $25 billion of volume. We project 7 companies with more than $1 billion of outstandings to default, unchanged from last year. Now, that includes Saks, which filed earlier this month. The red tier, which is the most worrisome category on default radar, stands at just $20 billion, which suggests this year's rate will remain low.
All right, so how about broadly syndicated loans? Are we moving lower than 4.1% in 2026?
Yes, so our 2026 forecast is a 3% default rate, equating to roughly $47 billion in volume. If realized, this would represent the lowest annual default volume since 2022. Only 2 potential defaults exceeding $2 billion are forecasts, compared with 7 that occurred in 2025.
All right, so lots of concern over the past couple of years around the BSL market, where we've seen some late cycle accidents. What's driving the improvement?
You're right, Van. Many of these credit cockroaches that Jamie Dimon talked about were in the BSL market. Speaking to you, First Brands, we believe these high-profile accidents have gotten lenders and investors to tighten up risk appetites and due diligence.
How about industries? What are we watching in 2026?
Right. The chemicals, glass, plastics, and packaging sector is expected to generate the largest volume of liquid defaults. In fact, Pretium Packaging and Multicolor Corp both filed this week and were already incorporated into the 2026 forecasts. Loan default rates in the sector are projected at 9%, with Vibrant Technologies and Trinzio Materials identified as the largest restructuring candidates. The high-yield default rate is also high at 7%. Software is expected to generate the second highest volume of loan defaults. However, the sector's large universe keeps the rate at approximately 2.5%. In high yield, telecom and consumer are projected to have the next highest default volumes, though rates are only modestly elevated at 3.5% and 2.5% respectively.
All right, so let's turn towards direct lending. Obviously, there's been lots of focus on the performance in the direct loan market late in the cycle. Do you see a higher default rate?
Yeah, so the preliminary 2026 default rate is estimated at 2%. Now, the figure remains preliminary, pending fourth quarter BDC results available starting next month, which could add 0.5% to the 2025 default rate through restructurings. Now, the 2025 default rate currently stands at only 0.9%. The expected increase in 2026, that reflects the default radar, which is at a high of 237 issuers, with 148 of those on the red list.
All right, so I did notice that Marathon's Bruce Richards cited your data earlier this week on software sector defaults. What percentage of defaults come from that sector and any notable names to watch in 2026?
Obviously, very excited to see Bruce highlight our data on LinkedIn. We estimate 40% of the 2026 direct lending default volume will come from the software sector. Medallia stands out as the key name to watch. It currently sits in our orange tier. Medallia's exposure across BDC holdings is the largest on the radar. Its fair value mark has declined for 5 consecutive quarters. Beyond Medallia, several other software issuers on the red list are prime candidates for restructuring this year.
All right, I got it. So default rates seem relatively benign across the three markets. Are there any worries out there as you look towards implied recoveries?
Yes, implied recoveries are a concern for me, along with the Jets organization ever getting its act together.
Now wait a minute. This week, the president said he will not be attending the Super Bowl. A beleaguered Jets fan said to me in a related announcement, the Jets said they are never going back to the Super Bowl.
Agreed. Who wants to go to the Super Bowl? I prefer studying mock drafts beginning around Halloween. But back to implied recoveries before I get myself even more depressed. So for direct lending, the trailing 12-month implied recovery rate stands at 51% and has remained near that level since we began tracking the market back in 2023. We do not expect improvement in 2026, with a weighted implied recovery forecast of 50% and an unweighted one of 43%. Now, for context, the average red issuer on our default radar, where the majority of 2026 defaults are anticipated, is marked at 52%. For loans, the trailing 12-month implied recovery stands at 52%. Our 2026 forecast is 50%. Then for high yield, the trailing 12-month implied recovery, that's slightly lower at 43%. For our forecast for 2026, we're looking at 40%, which is pretty much in line with that historical average.
Great. All right. Thanks for walking us through those various forecasts. Can you remind our listeners where they can find your research?
Sure, you can follow KBRA DLD on LinkedIn, and to receive our defaults weekly in your inbox or access all our reports on liquid credit and direct lending, contact Nikki Messino, which is niki.masino@kbra.com.
All right, perfect. I think that's a wrap. Eric, thanks for your quarterly update. We'll look forward to your performance again and your next forecast a quarter from now.
Perfect. Thanks, Van.
So there you have it. Three things in credit. One, what we're watching. Policy uncertainty, inflation, credit cockroaches, and AI. Oh my. Two, Visa Mastercard spending update. The consumer continues to spend amidst decidedly negative sentiment readings. And three, KBRA DLD default forecasts. The economy is performing better than expected, something reflected in our default rate forecasts. As always, thanks for joining. Don't forget to check in on KBRA.com for our ratings reports and our latest research. And make sure you download our forward look research reports for both the US and the UK and Europe at kbra.com/macrocredit. We'll see you next week.